I want to switch gears here and talk a little bit about food and energy inflation. How big an obstacle will inflation be for the economy and the stock market? And more importantly, of course, how can you make money off of it? Here right now is how some major commodities are trading. You can see on our big board here, corn futures up 94% from their June lows, soybeans up 51%, wheat up 80%. These are from the lows that we saw earlier this year, with oil prices and commodities like corn, wheat, and soybeans surging. Is inflation really a problem, and how can you make money in this environment? That's the question we're asking, and joining us with some answers, David Kelly, Chief Market Strategist at JP Morgan Funds, Keith Springer, President of Springer Financial Advisors, and I believe we have Michelle Girard with us as well. Am I correct?
I'm here.
There you are. Okay. Good to see you, Michelle. I'll start with you. You know, you look at today's PPI number, and it could cause some to be a little worried about the inflation prospects on the horizon. What's your sense of how real an issue this is going to become for the economy?
Well, I think it's become an issue that's moved sort of front and center, but it's something that we've been watching. The rise in food and energy prices, which so often is dismissed, is not being driven by, one-off factors. It's one thing to dismiss food and energy price rises when it's due to a shock like a hurricane or a freeze. What's happening now is that as a result of the Fed's, accommodative policy and a weaker dollar in 2010, we've seen commodity prices move up, and the prices of internationally traded goods are moving up. Food and energy is moving up. That's coming through in the headline. I think it's meaningful. I'm not sure how much of that will get passed through to the consumer, but I do think that prices are going to be firmer in 2011 than people expect.
So, David Kelly, taking on what Michelle is saying, you have very easy money Fed. Real rates are low, money supply is growing rapidly. Isn't there a danger that the Fed will accommodate and monetize individual price increases in these commodity areas into a generally higher inflation rate?
I don't think so, not over the next few years. I think I agree with Michelle about rising global growth pushing up food and energy prices. I think there is I've got a generally positive outlook in terms of commodity prices commodities as an investment area. But within the United States, the key thing is, does this translate into higher wages? And we had a test run back in 2008 of much higher world commodity prices. Did that have any impact on wages? And the answer is no. In fact, the latest wage reading that I've seen year over year is the lowest since 2004. If you short-circuit that process by which rising commodity prices feed through to higher wages, if you don't get that wage increase, you won't get a general inflation problem in the United States. And it really isn't a matter of the Federal Reserve. It's a matter of slack in the economy.
Keith, I don't know about that. I mean, when you're looking at gasoline prices in this latest survey going up 6.4%, it looks like they're only going higher from here if you take your cue from crude oil. At what point does that derail consumers, the economy, and then stocks?
Well, it becomes very expensive for the consumer to live when you have consistently rising prices. The consumer can invest in these types of things, but they have to be very, very careful, because commodities are typically played by very savvy commodity investors for the short term. An individual investor can get in and be a part of this on an investment purpose, and can play it through a basket of stocks. They can do it through an ETF. DBO is a great ETF. DBC is a wonderful ETF. But you've got to be careful, because the Fed is trying to induce some inflation. They can't create asset inflation. So what they're doing is, with the quantitative easing, they're doing their very, very best to create some form of inflation on this economy, and they're not going to stop until they actually have some.
Okay, well, with that in mind, Keith, if they're not going to stop until they actually have some, you're saying investors could look at commodities. Give us some other sort of actual, real tangible picks, ideas that investors can use to really hedge themselves from this potential inflation problem.
Absolutely. I mean, DBC is a wonderful ETF, which is a broad basket of commodities. Wonderful way for the individual investor to play it. Again, commodities are typically played by very savvy commodity investors who are playing the contracts, who are in it for the short term, and the individual investor has to be careful. But as a way to hedge, DBC is there. DARE is a wonderful way to play it. DARE has been doing very well and doing very well today. As you have a completely increase in prices of commodities, it's going to spill out into the equipment makers such as DARE. And there's another stock that I really like. It's more of a play, more of a fun stock. It's ERX. It's the 3 times oil bull. If you have a rising price of commodities, you are definitely going to have a rising price of oil. And oil is going to surge. And for speculative investors, that's an interesting way way to play it, a fun way to play it. You got to be careful with that one, but I think that one has a huge pop ahead of it.
Michelle, let me come back to you. Besides the inflation conversation, is there a second part to this in economic terms, that these price spikes in commodities, and it's really all the commodity sectors now, A, is a tax hike on consumer spending and income, and B, is a tax hike on corporate profits?
Well, it's you're right. It is like a tax hike. But getting back to sort of what you said, this is where it becomes so critical in terms of policy. If we say, okay, the consumer will be weaker because of higher energy prices, therefore the knee-jerk reaction in the marketplace is the Fed is going to have to keep monetary policy easier for longer because the consumer is struggling under higher energy. That's how you get the monetization that leads to broad-based inflation. So that's the problem. I think in terms of the corporate sector, it all comes down to whether or not monetary policy makes firms able to get price increases through. In an easy money environment, the pressure on profit margins shouldn't really be there. If firms should have more ability as the economy strengthens.
But they don't have that ability. I mean, I think that's what we saw yesterday in the Beige Book, is that they don't have it, and that's a big area for concern. David, how do you adjust your portfolio in light of this?
Well, first of all, that's exactly the point, that rising gasoline prices don't cause people to spend more, they cause them to spend less. And so I don't think that higher commodity prices will lead to stronger demand and stronger general inflation. But with regard to how do you adjust a portfolio, two things. One, don't bet on general inflation, so I think tips are a bad investment right now. And two, I do think commodities are a good investment, but invest with a professional manager. I really think this is an area where professional expertise, people who don't just have to go long a commodity, they can think about what to go long, what to go short. It's very important because commodities are really kind of the wild, wild west of investments. There's a huge difference in how different commodities do during the year. I think it's a good sector to have in a portfolio, but I think professional management is really necessary in commodities.
But David, all right, you're recommending the technology sector, and that's probably the most insulated from commodities.
Sure.
But I'm surprised you're still recommending the consumer discretionary spending in the light of the tax hike effect of higher oil prices, higher retail gas prices, and higher food prices. Aren't consumers going to get nailed first?
Yes, but if you think about commodities, commodities are a very regressive tax. Higher oil prices hurt the poor much more than the rich. Whereas if you think about discretionary consumer purchases like new cars, new boats, new big screen TVs, they tend to be more at the upper income levels. So in fact, this is a tax, but it's a tax on lower income Americans and shouldn't derail what I think is going to be a good rebound in discretionary consumer spending.
All right, we'll leave it there. David, Michelle, and Keith, thank you very much.